And we have with us Dr. Satyam David, who has come from Mumbai, who has done his MA in economics, and he has been in West Bengal. I mean, he has done his schooling from Asansol.
So, respected Chairman, Eastern Region, Sri Rupta, Vice Chairman, Mr. Datta, other office bearers, officials of Eastern Region ICAI, and also all the brave ladies and gentlemen who braved the weather to come for the session in the morning. So, thank you all for coming. I am happy you were able to come and brave the weather and wade through the water and risk your cars and come here. So, as Mr. Datta introduced, I had done my early schooling in West Bengal since my father was in the Eastern Railways. So, this weather is quite familiar to me. So, it is not very strange. And considering this session, ending this session, until 2011 to 13, I was in DPS Central Office, where one of my portfolios was audit regulation, where for banking audit a lot of intervention of RBI in the audit sector. So I had an opportunity to gain a lot of contacts in the audit fraternity, made a lot of good friends. I was seeing the certificates in Mr. Rupta's cabin. So I saw that all the earlier three signatories, presidents, were known to me. Mr. Raghu, Mr. Ramaswamy, Mr. Shah, and earlier Mr. Amarjit Chopra, your president long back, also a good friend of mine. Both of us were on the board of Indian Bank together. So this audit is one issue which RBI is, we are actually partners in regulation of the financial sector. And one issue which is gaining importance now, especially in DBS, there's a well laid down pattern. There are certain qualifications by which auditors are enrolled to be in the panel for banks. But since NBFC, we do not have any statutory powers for appointment of auditors. It is as per the Companies Act. But under our RBI powers of the RBI Act, we have issued several regulations for regulation of proper ensuring supervision of the NBFC sector. The NBFC sector is one where we call, in the banking sector, they call it the tripod of supervision. Here we have four pillars of supervision. One is by RBI on-site inspections, RBI through off-site returns, RBI again through, not only RBI but various agencies through market intelligence being the third leg. And fourth most important leg is the auditing fraternity. Because here, unlike banks where there are some 80-85 banks, and out of that 25 are PSBs and a large majority around 40 are foreign banks. So here the number of entities is around 12,000 or so, which we really do not have the network, nor the manpower, nor the resources to audit. So to a large extent we rely on the audit fraternity to see that our regulations are followed and the sector develops in a proper manner. So in the recent past there have been, with the new government coming in, there has been a lot of activity. You may or may not know it, there are two parliamentary committees. One was the Estimates Committee of Parliament, which was given the mandate to suggest new forms of regulation supervision for the NBFC sector. Then the Standing Committee on Finance also is looking into regulation of this sector. And Kolkata has been a center for NBFCs, whereby there have been large number of NBFCs, and unfortunately there have been several incidents of certain fly-by-night operators or even large entities collecting large amount of public money and then misappropriating or misutilizing the same and going out of business and leaving the public in the lurch. So this being a focus area, and parliamentary committee is also questioning what is RBI's role vis-a-vis audit and how do you strengthen the audit segment so that they are useful as a tool to give you early warning signals and market intelligence. So in Central Office itself, we were planning to open up interaction with the audit fraternity, and fortunately this meeting came up and Mr. Sahu said, would you be interested in coming? So promptly I jumped at the opportunity and took this up. And in between we have also been interacting with the ICAI Central Unit in New Delhi so that we would have better consultations and formalize how to go about regulating the sector in a better manner. So regulations in this sector, as you see, non-banking NBFCs in India have evolved over the last 50 years to emerge as notable alternate sources of credit intermediation. And in India, the non-bank sector is comprised of a wide range of entities. There are loan investment companies, housing finance companies, infrastructure finance companies, asset finance companies, core investment companies, and new entities like microfinance and factoring companies. Of course, in the broader sense, this also encompasses companies like stockbrokers, those involved in the stock market, share market, and insurance companies, chit fund companies. But again, we have separate the evolution of SEBI. So those involved in share market have been kept under SEBI's SEBI's regulation, and those without share market coming under the financial sector or conducting bank-like activities without being official banks have come under the RBI's regulation. And the regulation has evolved. Of course, earlier regulation was quite light touch and they were not being supervised very intensely. So only over the late, with the liberalization and that time it was that Marathi committee report, I think. So the Marathi committee, the NBFC sector was liberalized and large number of entities were authorized during the early 90s. And when this banking sector and the 90s reforms, a lot of activity in the economy also picked up, and along with activity, the financial companies also started booming. And that time I was posted in Chennai, in the staff college, and Chennai again, apart from Bengal, has been a center of NBFCs. Since early days, they've got traditional companies like chit funds, which are prevalent right down to the grassroots levels, and doing very well, apart from a few major instances. And they've got those benefit funds or nidhis, which are again traditional since hundreds of years. They have been around and giving good service to the community at large. But this time when the economy took off, liberalization, and a lot of fancy MBS came into the play and set up nice companies with very good looking offices and very plush offices will set up and huge hoardings. Chennai has this practice of huge hoardings, whether it be political leaders or movie stars or when they came to finance companies also, we got into the competition, you used to find huge hoardings, Sarana Finance, XYZ Finance, this jeweler, that jeweler, and promising all kinds of 17%, 18%, 22 effective rate of interest, plus gold coin, silver coin, and all kinds of facilities. But unfortunately, many of them, and many of my colleagues itself had put money, and in a year, many of them had got due return also. Only the second round of people who put in could not get back their money because their money went to pay back the interest and gold coins of the first round of people. So that time again, a lot of intervention was there. Chennai office, I remember, almost under the powers of RBI Act, went on a market intelligence visit to many of these companies, and then finally there was a fallout. And again there was a major fallout of CRB, which was a large company almost on the verge of becoming a bank, and it was on the verge of getting a COR. Before the COR, of course, it led to problems and it collapsed and defaulted. When this 1997-98, the regulations were revamped, it was committee was set up and it was thought they'll have minimum net owned funds criteria above which only companies will be eligible to do this business, and then all companies which had to do the business had to register with RBI in the form of a COR. And subsequently, of course, this limit has been raised and a lot of further regulations have been fine-tuned on the basis of experience gained. And a large number of companies, initially there was of course a lot of pain and shakeout, but we are glad to say that in the recent past, companies under RBI's registration and regulation have done fairly well, except for the unfortunate incident of Sarda Group here, which were basically not finance companies. They were doing financial activities, raising funds, deposits from the public in the name of various other names. And so again, that is again one area where deposit, the definition of deposit is itself being expanded, and we have placed brought proposal for legislative changes to trying to expand the definition of deposits itself in the form of saying that any advance against good services where the company might not be in a position to deliver the goods and services rendered. So that itself will be treated as deposits and treated as illegal if the company is not in a position to render whatever the service that it has promised to render. So today, while numbers were, I think in 1997-98, there were more than 20,000 finance companies. Of course, this was, no, we did not have any proper record, but as per the general estimates, registered, unregistered, more than 20,000, which came down to around 14,000 when the CORs were issued. And now it has come down further to 12,029 by March 2014. But many of them have found a niche for themselves in the financial system of the country. And it may be also interest to you to know that Kolkata has 5,617 NBFCs registered as on date. And NBFCs definitely play a vital role in financial intermediation and complement our efforts for financial inclusion. Now, many of the inspection reports you have been seeing last year, we find that companies are diversifying away from traditional traditional consumer durable loans, consumer vehicle or commercial vehicle loans, and diversifying into SME finance. When I ask them how do you finance and what are the securities, what are the safeguards that you take, considering the MSME financing in banks is leading to a lot of NPAs. What's happening here? They said, no, basically this is loan against property. And we are financing, then again ask them now, see the banks give SME finance at very cheap rates, 12% with a lot of other benefits and facilities. And when they get a package from state government and banks, there are a lot of sales taxes where power tariffs are subsidized. They get many of the banks up to certain limits, they bear the CGT SME fees. They also do a lot of handholding, give them a lot of support and extension facilities and consultancy facilities. Ask them now why when a bank is giving at 12%, now why would anybody come to borrow from you at 18%? We are saying the track record proves itself that we are expanding our loans in this segment. And your inspectors also have seen these are being expanded. It is due to our quick service, low documentation charges and all the facilities that we provide, that they are willing, and the relationship that we build up over a longer period, that they are willing to come to us even at 18% rate of interest. So they are doing human service to a large extent. So we must not forget that they are doing good service and rendering very valuable function in the overall development of the economy and financial intermediation. And in spite of banks being available in every nook and corner and providing facilities at much better cost. So there is one thing, but what is important is that see the profits here are large. When I joined the department, I have seen the financials. Now, the financials of many of the companies are very good. The NIMs are very high. Return on equity, average, maximum return on equity for a bank, at most if it's getting 15%, it's very good. Return on asset, if a bank is getting, say, more 1.5 or above, we think that the bank is fairly good. One is, okay, we are happy with one nowadays, return on assets for banks, considering circumstances. 1.5 and above or 2 is treated as very good, and NIMs of say 3% or 4% we feel is excessive for banks. But here NIMs are 10%, return on equity is some of them are 25 to 40%, ROA is sometimes 6 to 8%, 4 to 6%. And find out why, how underlying, what are you doing? So they say now we have freedom, now interest rates, so people are willing to bear extra our cost of the establishment costs are lower. So even if they are, basically they are borrowing from banks, financing clientele that the banks could have financed themselves, much lower rates and making much higher profits. So it's a very efficient sector to get in. Plus they don't have the problem of priority sector, no SLR, CRR requirements unless it's a deposit taking company. And the level of RBI inspection also is not as intrusive as is done for banks. So overall it's a good sector, but of course because of various other levels the scope for expansion and growth is not there. But many other companies are quite happy doing business even locally or regionally. I especially had this experience when I was RD of Jaipur for 2 years, 2013 to end of last year. So wherever I used to travel, I used to find Manappuram and Muthoot. Every Mofussil town near the bus stand, very good premises, very prominent offices. Even commercial bank offices are not so prominent. Then ask the local people what are you, and many of you are from Rajasthan and from the names I can make out. Now the South Indians, they are willing to pledge their gold, take gold loan, it's a traditional habit. Rajasthanis will not pledge their gold, it is a family heirloom handed down through centuries old, and they do not pledge. Then I ask them about how do you get this cultural hang up sorted out. They say no, we go do marketing, whoever comes for business purpose or trade. We show them the advantages, you pledge gold with us, you get it back, and you get finance also much faster and quicker without going through the problems that you face with bank. So Muthoot, Manappuram, very widespread. In case I was quite surprised that traditional Kerala-based companies are so widespread in interior Rajasthan, not even just the main cities. So to safeguard the system that we have going and keep it safe, there are a number of expectations that we have from auditors, because now you are there with the company on a continuous basis for years together. Only now with the new Companies Act, the partner on a particular auditor will have to be rotated after a particular stipulated period of time. So you are doing what the companies are doing, you are knowing whether they are fulfilling, and many of these companies, some of them, to a large extent, they are smaller. The bigger companies have their in-house CAs, in-house financial managers who know what are the norms to be followed. So it is our expectation is, at least for the smaller companies, you should be the guiding hand. So RBI, through the master circular, various periodical circulars and master circular on non-bank financial companies auditors report, Reserve Bank Directions 2008, now which has been updated further by the master circular issued. So it issued instructions on the role of auditors. Now I'd just like to highlight some of the important directions that to be brought out by the auditors by the NBFC Auditor Report Direction 2008. Now in case of all NBFCs, whether they are meeting the PVC criteria, whether they are engaged in NBFC activity, and whether they hold a valid COR, and the auditor has to certify as to whether the NBFC is correctly categorized as an MFI based on qualifying assets. Now this is very important. Now any company which is above crossing the PVC has to automatically come to apply to RBI for a COR because there are any financial activity where any company is identified or defined as an NBFC or NBFI has to come under a regulation. So earlier, of course, regulation requirement was mainly depositors' protection. And now that deposit-taking companies are few and a lot of safeguards have been imposed and a lot of restrictions have been imposed, they are much less in number. But the importance again is financial stability and systemic impact, because we have opened up now banking sector funds to companies and it is available easily now. Till last year now, I was on the board of an Indian bank. So most of the large proposals now, as you know, banking sector is going through a problem, the downturn in economy, rising NPAs of infrastructure sector, and slowdown in industries where industrial growth is not happening, so companies are not expanding their capacity, so no offtake of credit. I used to find large proposals coming only from infrastructure sector, which is discredited, or from NBFC sector, and bank was willing to lend to NBFC sector very willingly. 100 crores, 200 crores, 500 crores. Each bank was lending on multiple banking arrangements, and the level of NPA is also much less. You see the overall statistics also, bank lending to NBFCs over the last 3 years has been increasing much more rapidly. And bank, actually NBFC sector assets itself, total business has been rising much more rapidly than of banks. So it is important now that the financial stability is an important aspect now. So since NBFCs are borrowing from banks, if the NBFCs start defaulting, then there will be a big problem right down the line, cascading effect will be there, it will spiral downwards. and banks will not be able to lend to other productive sectors if there is a large scale default. And NBFC sector has also been opened up to finance from abroad. FDI is permitted, they are permitted, ECB is also, and this was one source of instability during the Asian crisis, when large number of the non-bank finance institutions there, which were not subject to very close regulation, had taken a lot of foreign funds, and then when the local currencies started depreciating, they had to face a lot of problems. They could not repay the foreign lenders their money because their currency had depreciated rapidly compared to the dollar borrowing. The debt was denominated in dollars, so automatically they could not repay their borrowings to their lenders in the local countries, and also their assets started defaulting, and crisis went spiraling out of control. Again, one rumor is that there is a person of Indian origin who had done a lot of foreign exchange dealings in a particular public sector banks, who was caught and who was suspended sometime during the 80s. This fellow went to Thailand and started an NBFI there, and did a lot of activities. The first NBFI, it was over leveraged there, was supposed to be from an Indian party. Anyway, that is one story which goes around sometimes. So coming in the case of now NBFCs with the deposit taking, it is pertinent that the auditor now number of restrictions are there, rating requirements and ceilings for different categories. So it is pertinent that the auditor submits a statement indicating, among other things, 3 important items, that is whether the public deposits are held by the companies in excess of the limit fixed by RBI and the manner of the regularization. Second, whether credit rating has been assigned for each of the fixed deposits and whether the aggregate amount of deposits at any point of time has exceeded the limit specified by the credit rating agency. And thirdly, it is important that the auditor correctly evaluates as to whether the NBFC has complied with the liquid asset requirement as prescribed by the bank under section 41(45)(1)(b) of RBI Act, and whether details of the designated bank of the approved securities are correctly communicated. Again, in the case of NBFC, NDSI, it is the responsibility of the auditor to ensure that all prudential guidelines have been followed while calculating CRAR, and also to ensure that all required regulatory requirements are submitted on time. Auditors are also, returns is one aspect we are serious about, because now this data requirement is becoming quite important. Data, because internationally there's Basel Committee, you must have heard of BIS, Bank for International Settlement, which has that Financial Stability Board. And Financial Stability Board, one of their mandates is to look into what they call the shadow banking system. That is, all non-banks they classify as shadow banks. And different countries have different levels of regulation over these. And even in the last 2008 financial crisis, it was the shadow banks which triggered off the crisis and finally percolated and created a contagion for the banks as a whole. Because all, everyone knows that sort of Lehman Brothers, it was an investment company. The problem for investment companies came because of the collapse of AIG. AIG basically is an international insurance company. And insurance companies are very stable. They got long-term funds from people via premium. And they also, asset financing also long-term, they try to keep it long-term, safe assets and do a little bit of lending as per their internal norms. But AIG had another subsidiary called AIG Securities, which was registered in London and not coming under direct regulation by anyone. And at the same time, England had relaxed their supervision. They said we'll go for light touch supervision, principle based, because the general financial markets have matured and because of IT and technology and improved analysis, economic analysis, data availability, prospects of problems is much less now. So with the light touch supervision and all the subsidiarization and one company subsidiary, insurance company subsidiary, insurance companies itself are likely regulated. That fellow had another subsidiary, which is even of lighter regulation, but who was highly over leveraged and doing huge, massive amounts of off-balance sheet transactions with no relation to his own transactions. So, and the entire, once that collapsed, it led to multiple collapse all down the line. So this is one thing, it's important that FSB is supervising, and we need a lot of data, and the data requirements are quite stringent. So we also now revise, as you have seen last night, there was a circular on this revised Cosmos, 500 crore and below. Now there will be only an annual return, much more simplified, basically containing the balance sheet parameters, and 500 and above the usual data will continue. And that these data requirements are quite important, because out of data and analytics, we can analyze a lot sitting without going to the company itself. So this is another aspect you should see, that the Cosmos data is properly filed, properly uploaded by the companies. And auditors are also expected to give reasons when there is any qualified item or unfavorable item. In case of any item where a company has not complied with provisions of Chapter 3B of RBI Act, or non-banking financial companies acceptance of public deposit directions 98, or NBFC deposit accepting holding companies prudential norms directions 2007, or systematically important non-banking financial holding companies directions 2015, and non-systematically important non-banking financial non-deposit accepting or holding. This is all quite a mouthful, and DNBS has evolved a lot of terminologies to fit in different categories. Now we have a tendency to, we need to name every small category into a proper sub-segment. That's why there's a whole variety of NBFCs available and a whole variety of NBFC directions also available. Company Prudential Norm, the Reserve Bank Directions 2015. Now this, because of the new norms of November 2014, this the smaller companies are now getting called non-systematically important. Smaller companies are not called anything, so now there's a name for them. So it is the obligation of all auditors to report such contraventions about non-compliance to the concerned regional office of RBI, within whose jurisdiction the company falls. But as under Section 48 MA of RBI Act, auditors are also required to report to the bank about companies which they have audited, which are carrying out NBFI or activities without a valid COR from the bank. The exception reports are also not being submitted to the bank. The bank, in case of non-compliance, can consider penal action as defined under Section 58G of the RBI Act. Now again, about change of control of management. In number of cases, it happens without the prior approval of RBI. And see, the number of approvals, deposit taking company, changing a registered office, or change of other office, change of management. These are all requirements that are required by RBI for one regulatory reason or the other. So these are all aspects again which you should educate the companies about. Now we are very happy for companies which are compliant with us. So for some reason companies have a fear of RBI, which actually need not be there as long as they are complying with the law of the land, or one or two basic mistakes are made, genuine mistakes we are willing to condone. It is not that we are after everyone with a big stick. It's like a traffic cop waiting just behind the signal and not visible to the driver either, behind some parked car or behind some tree, and will jump forward just when you have crossed the yellow signal. So we are not like that. We are not waiting to collect penalties. That is not a source of income, or neither do we get any incentive for collecting penalties. We are there, we hope, we are there firstly fund for protection of depositors' interest and systemic stability, protection of consumer interest in case of companies which are lending. So no unfair practices. As long as practices are fair, a little bit of cutting yellow lines on that we are willing to condone if the companies are upfront. So, but you find the general reluctance companies try to do this sort of creeping change of management companies. I don't know why this large number of companies based in Chandigarh basically promoted by Sardarji, so we are getting taken over by people in Bengal. All Bengalis taking over companies promoted in Punjab. So these kind of things we get suspicious about. The local company, local incorporation, some synergy is there. There is no need for change of office, cultural and other differences are not there. But this sort of companies which are just taken a COR and then shopping for CORs and shopping for licenses, we get a bit suspicious what is the reason for takeover. So then we start questioning. Then again the importance is the fit and proper management. That is one thing that we are very particular about in Reserve Bank. And it is a worldwide phenomenon. Any financial regulator, any financial company that is coming under regulation of any central bank, we are very bothered about that term called fit and proper management. So the directors' due diligence we do very thoroughly, and the number of sources we get information from. So that if you see that statement to be submitted for budgetary directors, there are a lot of items involved, bank accounts, various other accounts, various other particulars. And again, since we are supervisors for the banking system and the entire financial sector, we get the information about them from different agencies. So that is one thing that we are very bothered about. So even if it is within the same family, within the same group, if the directors are changing, different individuals are coming, we would like a proper report about each of them. So these are certain guidances that you being the auditors of these companies should be willing to give them. Again, per se we are not against companies being taken over. Rather than a large number of government companies, if they are being taken over by parties who are genuine, we are quite happy with it so that we know that it is taken over by a good party. In fact, recently only 3 or 4 proposals I myself approved. There was some one MFI wanting to take over government NBFC somewhere in South India. They wanted to set up and they wanted to make a registration. So they felt this would be a better route. They took over government NBFC which had no issues but it was just government. So these are things when we are convinced about the genuineness, we give quick approvals also. And similarly about mergers, amalgamation, and recently we had this huge exercise of tallying our information vis-a-vis the information of Ministry of Corporate Affairs, where a lot of anomalies, dichotomies are found, and then we found a lot of companies who have basically NBFCs do not have COR and have been continuing business. That is also one issue which is engaging our attention. And again, NBFCs, companies trying to merge, who do not have a COR, a company without a COR trying to merge. These are all activities that you should be able to guide the companies on to see that they come within the regulatory requirement. So as only saying, the total number of NBFCs as of March was again 12,029, of which deposit taking NBFCs were 241 and non-deposit taking NBFCs with asset size of 100 crore and above were 465. Total assets of NBFCs which stood at 5,60,000 crores in March 2009 grew to 14 lakhs. So almost 3 times as at the end of March 14. In the year 2013-14, total assets of NBFC sector have grown by 13.36%, while assets of banking sector have increased only by 5.36%. The total borrowings of NBFCs grew from 3,75,000 crore March 2009 to 9,98,000, almost 10 lakh crores as at end of March 2014. Again, 3 times growth. There has been sizable growth, very high leverage, increasing dependence on public funding and increased interconnectedness. But the regulations on NBFCs are lighter than that for the rest of the financial sector. So in this backdrop, it was felt that with the mandate of RBI of financial stability, deposit protection and customer protection, some of the guidelines would be revisited. This is coming to the new regulations. So in this context, in order to simplify regulations, harmonize regulations and make it more effective, it was decided that a timeline of April 1st, 2017 would be provided to all legacy NBFCs to attain an NOF of 200 lakh. Again, auditors are expected to play a proactive role in order to ensure that their NBFC clients adhere to a roadmap so as to capitalize themselves adequately. As in the absence of adhering to timeline, they may face regulatory action. Because apart from this, also the tightened NPA norms also had to adhere to 90-day norms, will again weaken in a matter of 2 years or so. So these are aspects which the NBFCs have to plan in advance. This is not something that they can suddenly achieve. They should not wake up in the middle of 2017 or 16. They cannot achieve it overnight. So they have to start planning it over a 2-year time frame which has been given to them. And this is something again you must guide them and insist that they follow. The bank, of course, has not given any COR to any NBFC, deposit taking NBFC since 1997. Total deposits as of March 2014 was 20,588 crores, held by 241 companies. Concentration of deposits exists with a few NBFCs. In the absence of an institutional safety net, insurance safety net, and institutional grievance redressal system, the deposit taking NBFCs are subject to prudential regulations almost similar to that of NDSIs. The bank has harmonized deposit acceptance regulations by making minimum investment grade credit rating compulsory by March 2016 and aligning the quantum to industry levels at 1.5 times NOF. For a smooth transition, deposits held by these such NBFCs in excess of revised limits will be allowed to run off up to the date of maturity. Now again, auditors of deposit taking NBFCs need to observe that their clients adhere to this benchmark. NBFCs D will also have to follow the deposit acceptance guidelines. As regards non-deposit taking NBFCs which are not systematically important, they will not be subjected to prudential regulations or conduct of business regulations, FPC, KYC, etc. They do not have access to public funds or they do not have customer interface. But these will be applicable as long as they have customer interface. Those having customer interface but no access to public funds will only be subject to conduct of business regulations. But those accepting public funds will be subject to limited prudential regulations but not conduct of business regulations if they have no customer interface. In case where both public funds are accepted and customer interface exists, such companies will be subject to limited prudential regulations and conduct of business regulations. However, registration under 45(1)(a) of RBI Act will be mandatory. And we will be again following up through the pattern of returns. Out of 12,000 NBFCs registered with RBI, as many as 11,598 will be regulated by the simplified regulatory framework. So the large number, there will be hardly around less than 500, which will come under our stronger regulations. Threshold limits of NBFCs and NDSIs are now being fixed at 500 crore and core capital requirements strengthened. Existing 7.5% is made to 10% over 2 years. Asset classification norms have been aligned with that of banks from current 180 to 360-day norm for loan, HP, leased assets respectively to a 90-day norm over a period of 3 years. And higher standard asset provisioning also has been put in place, 0.4% against existing 0.25% over a period of 3 years. So challenges faced by regulator are multiple. First challenge is that of bringing within the fold entities which should have but has not taken registration from the bank. Suitable corrective action has been initiated. So I request all of you to actively participate in this endeavor. Second, it has come to our notice that some entities without authorizations have been raising public deposits. Again, the policing is to be done by auditors. If those without coming under norms, against the norms, are raising deposits or deposit-like instruments or deposit-like facilities, anything, concealed deposits, it is up to you to put us on caution. That is why, because after Sadhasam, we have again elevated the status of the local SLCCs from the supervisory angle, bringing in a large number of entities or supervisors together, consisting of ICAI, states, the Chief Secretary being the chairman, and the police authorities, so that there is due importance given, and so that any reference made by one agency is not lying with another agency without due importance being given. SEBI is also part of the SLCC team along with MCA people, ROC people, the local state governments. So please, again, I would like you to see that at the ICA level, senior participants is ensured at all the meetings and the things are taken in good spirit. We have received now reports of little squabbling between participants in different SLCCs. Now some people might prone to make strong statements, or some people feel that some slur or charges have been cast on auditors in some places. The ROC people feel that they are being questioned, or sometimes the police feel that they have been told that they are not doing their job properly, or state government says RBI, this is RBI, and RBI should not push everything on others. Now there might be differences of opinion, but this is a forum set up for the mutual benefit of all the parties concerned. Now each of us have their egos, but this is one thing I would request all of you, especially ICAI. This is something that both of us being joint regulators have to walk hand in hand and in a mutual cooperation, so that the system and both of us being mutual regulators, that our name is safe. Because once the problem comes out in the open, there's a big default, then all the dirt hits, it sticks to RBI, it sticks to audit fraternity. Immediately questions are raised. Any large company fails, first thing they'll start is what is the auditors doing, and if it's a finance company, what is again also RBI doing. So we have to protect our reputation. You are professionals, you are professionals with a strong reputation. And again, entry barriers, especially into ICAI, is very strong. It's very difficult to get through exams. I don't know what is the pass percentage now. When I had finished college and what Nitya and I, jobs were very difficult to get for normal arts graduate. And I was telling you people that ICAI Chennai was very active. So it was there near our staff college. So ICAI Chennai was there, and a lot of, at that time, majority auditors were from Kolkata or Chennai, South India. And Chennai audit, everyone after college used to get into become an article clerk through some uncle's friends' companies or somewhere or the other. Whether it goes on firm or not, another question. Whoever you ask, nobody will say, no, I'm Sadiq Varta, will say, no, I'm doing ICAI, CA. So there was a big bus stop opposite. There was a big, at that time there was a big, there was a church also there. So there was a church poster saying, Jesus never fails. Below that, some fellow had scribbled in broad French pen, ask him to write CA entrance exam. So as I said, the entry barriers are high, and once you get in, you have a reputation to protect. Now, I have that in Rajasthan, Bhilwara has a major center for CAs. They have got big coaching classes. So maximum CAs and company secretary graduates are from Bhilwara. So you have to take care of this and ensure that fraternity is protected. And again, we have received questions from the parliamentary committee what action was taken on CAs in respect of companies. They asked us a list of companies which have defaulted in deposit taking. So we have also towards certain norms as per the RBI Act, there's a penal provision which we have not been invoking. It was again a very menial amount, some 5,000 per instance. But again, the naming and shaming is a bigger matter. So again, we have what we are proposing is through the thing that if auditors' comments are not acceptable or deficient or are not acceptable to us. Again, here, as per Nationalization Act, the RBI shall appoint auditors from a panel for commercial banks. Here, we do not have any power. So, as per the Companies Act, the companies have freedom to appoint. So, our thinking is that in case our reporting under our directions, we find that particular auditor's reporting is not satisfactory, then we'll tell the company that we are not happy with this auditor's reporting for such and such reasons. Everything, of course, has to be documented. You cannot do things in an arbitrary manner. So you have to replace the auditor and take a different auditor for our certifications. Or extreme cases also go for penalty and for reporting to ICAI. Because we have a subcommittee audit of the Board for Financial Supervision. Again, it is headed by our Deputy Governor and main member there is Sri Malegam, respected chartered accountant. I think he will be known to each and every member of the audit fraternity. So he is also very keen that the auditor's responsibility is essential in these matters. So please again educate while you hold these sessions for NBFC auditors. Because a large number of small NBFCs, many of them have inexperienced auditors, or those who are new are not aware of implications. So please try to educate them that audit is an important aspect. How all the companies and that adherence to all these requirements, starting from COR for companies who are undertaking NBFI business, to return submission, to other exception reports, all are given due importance by RBI. Again, parliamentary committees we asked us very pointed questions. They asked us of percentage of compliance for each of the items, and we found that different places percentages as low as 60% or 70%. So, saying what action has been taken on the rest of the auditors? So, out of 12,000 companies, 60% compliance, that means almost more than 6,000 companies auditors are there. So, it is beyond our capacity to start questioning all the auditors and take them all their explanations. So, that's what we thought better than going for strong action. Now, that is, the strong action is not the solution. It's better interaction. Both of us are professionals. Better interaction, better education, and upskilling of the auditors, especially of the smaller companies. So will yield better results than this disciplinary action. So then, of course, third, fly-by-night operator menace is being tackled through market intelligence, enhanced cooperation and coordination between regulators and law enforcement agencies. So finally, I expect the ICAI fraternity to participate proactively in providing us market intelligence and inputs in a timely manner so that preventive action can be initiated. I know all this is work in progress, but I am confident that together we can build a robust NBFC sector. So thank you all again for coming and participating so keenly, and I hope you will. Unfortunately, because of the weather, we could not get a better participation. Hope you will be again in turn able to disseminate this message and make people aware of the importance of following our regulations, especially regarding the NBFC sector. Thank you again for your patient hearing.